Bueno, pues bienvenidos un día más a Casting Stories. Aquí estamos con la segunda parte de la entrevista que estamos haciendo con Tobias Carlisle en Madrid con motivo de la reunión anual de socios de Zonavalue, con motivo de la presentación en España del libro The Value, traducido al español, que Zonavalue Club ha ayudado a traducir y a publicar en España. Hello, Toby. Thanks to follow this interview. Let's follow the interview. Talking about one thing that is important for us, that is when you start investing, you change from lawyer to investor, and then you create your own ratio, and your own screener to screen the market.
Right.
Why did you do that? Do you think that ratios are important, very important, the most important thing when you invest? What do you think about it?
I read Joel Greenblatt's book, The Little Book That Beats the Market, and it was significant because he read through all of Warren Buffett's letters, and he simplified what Buffett does down into two ratios. And those two ratios combined together, he calls the magic formula. But those two ratios are, on one hand, return on invested capital, which is a measure of how much profitability a company has relative to the amount of money that is invested in it. So if you think about it like a bank account, if you put $100 into a bank account and you get a 5% interest rate, you get $5 back. So your return on invested capital in that bank account is $5. So that tells you how much money that business can make over time. But then it doesn't tell you how much. If someone says to you, I have a bank account that has $100 invested in it that makes $5 a year, how much do you want to pay for that? Do you want to buy that bank account from me? You could say, well, interest rates right now are 10%, so I can get 10% somewhere else. So I won't give you more than $50 for that bank account. So the way that we're doing the analysis, so that's the way Buffett is thinking about these things. He's looking at the quality of it. The problem is that when you invest like that, the $5, you don't get $5 every year. You get $2 one year, $7 the next, $3 the year after, and you don't know necessarily where you are through that process. So it's a more difficult assessment. If it's making a profit that is greater than you can get anywhere else in the market, there might be other people who come along and say it's easy to set up a bank account. I can get $5. I can sell those bank accounts. So the valuation, the competition for that investment dollar drives down the returns that you can get by investing in them. And so that's known as mean reversion, and that's the business cycle. And when we test the magic formula using return on invested capital and the valuation metric, which is earnings yield, which is an operating income on enterprise value, when we test that, we find that all of the return and a little bit more comes from the value side of the equation, which is the enterprise value on operating income. And the return on invested capital side depresses the returns that we could otherwise get. So if we take out that return on invested capital measure, we do better. We do better on a raw return basis and an adjusted return basis. So I created a screener that only looks at the value side of it, because that's the thing that I'm interested in. It gives you the best performance. It sounds counterintuitive that you should ignore this particular measure of quality, which Buffett says is a very good measure, but it works better for the reason that return on invested capital is highly mean reverting. And Warren Buffett's great genius is that he's able to find these companies that have a sustainable high return on invested capital, which is very hard to do. So there's a lot of folks who say investing on the basis of ratios is too simple, that you should be doing more to it. And I agree to some extent that you can do further analysis and you can potentially improve your returns, maybe. But by investing on a low ratio, it stops you from doing a lot of the bad things that you can do in the market. It stops you from overpaying for businesses that aren't very good. You're forcing yourself to only buy the very cheapest of the companies. And some are value traps and deserve to be there, but many are undervalued and will do very well. So I think that there's nothing wrong with investing using ratios. That will put you so far ahead of most investors that it's worth doing it that way.
And in regard to that, could you elaborate a little the idea of being a business owner or a quantitative approach, following a quantitative approach, because you can use a screen, but then you can do a further analysis, as you mentioned. So what is your idea? And I'm a big fan also of Joel Greenblatt.
Weird.
So I don't really think that there's good arguments for doing both. There's no reason why you shouldn't do one or the other. The quantitative approach is to say, let's take an idea of the way that we value companies, and let's build a quantitative screen, a model, and then let's test that against data going back 30, 50 years and see what we could have done with a screen like that. And then if that delivers satisfactory returns, then we could implement that now. And it's important if we do it that way that we don't change what comes out of the screen.
Exactly.
Don't cherry pick the screen. And the reason for doing that is we cherry pick out the wrong things. Yep. We're instinctively going for trying to remove the things that will deliver the best return. And the reason for that is everything that's in the screen has a problem with it, which is why it's undervalued.
Yeah.
And so they have this idea called the broken leg theory. And the broken leg theory is we have some model for whether you go to the cinema on a Friday night and you like action and you don't like going out when it's raining. And so we can put all of these things in our model. And then we learn one Friday that you have a broken leg. Do we then change our model? Do we override our model because the model doesn't have that information in it? Should we do that? And so the answer is no. And that sounds crazy. Why shouldn't we take into account the fact that you have a broken leg? And the reason that we don't do it is because we want to exercise our discretion all the time. It'll be a broken leg this week. It'll be some other reason next week.
Exactly.
And so what the screen does is it behaves as if it's playing blackjack, counting cards. It's trying to do it in a way that we know over time will win. And so we apply those rules knowing that in any given week it might be wrong, but over time it's going to be more right because we're going to use our instincts incorrectly. So the business owner is a slightly different approach. A business owner requires that you then go a step further and actually do a valuation. So you say these are companies that we know that on average will work, but we're going to actually undertake a valuation. We're going to try and work out a range of values. Is this worth $50 or $100? Do we think that it's going to lose a lot of money over the next 3 to 5 years, or will it be worth more over 3 to 5 years? I think as a value investor, you can do either. The advantage of doing the business owner approach is just that you become more intimate with the companies, you know them a little bit better. As long as the approach is consistent and disciplined, and we try to take many of the ideas from the quantitative side and apply them on the qualitative side or on the discretionary side. And then in some ways it's like cherry picking, but it's a slightly different approach to it intellectually to simple screening.
Warren Buffett said always that evaluate a company is always an imperfect exercise.
Right.
That you can do it and it's always imperfect. You never know that this is right or not. And it has to be with the things that you are saying, because when you are disciplined enough and to follow this kind of screen way of investing, you have something that is objective, something that you can follow in an objective way. If not, if you go to the business owner way, you enter in the line of the subjective way, the quantitative or qualitative analysis, no? Qualitative. And there you can be lost forever. First, no? Because
I agree.
Which are the things that you are gonna catch when the things go wrong?
Right.
Which are the objective things that are gonna support your feelings when the things are wrong? This is one question. And second question, is a lawyer mind that is an objective mind and wants to have everything organized
Yeah,
a good mind to be a quantitative investor? Maybe, no?
I agree. You need to be, you need to follow the same process for every single position. You need to, and I have a process that it involves, we take the screen, and there's a lot of work already in the screen to get it to where it is. And then we go through, the focus of the valuation is to identify the economic reality of the business. So sometimes what the financial statements do, because managers want to put a good face on the business, they want the business to look better than it is, they might overstate earnings, they're changing some ratios in the business, and so there are things that we can do in a discretionary way to maybe take those earnings down to a more sustainable level. And you're right, that's a disciplined process. You know, one thing about being a lawyer, you get used to listening to people who are lying. You get used to looking for the errors in documents, and that's sort of what I'm trying to do now. I'm trying to look through the financial statements to find the economic reality underneath, find out how management is making something look a little bit better than it otherwise might be. And when we find those things where management is mostly telling the truth and it's a better story, or the story is better than it looks on paper, we become very excited, because that's, you know, that management team is doing the right thing. And hopefully they're buying back stock and doing other things like that. And those positions can work very well.
Mm-hmm. Now I have a question in regard to the way you apply your strategy. In the long side, you use a 130% long, and then in the short side, a 30% short. So you keep having a 100% long net exposure. So do you think this kind of balance gives you a better expected returns, and why?
So it's 100% exposed to the market. So in one sense, it's like a long-only fund.
Exactly.
And then it has attached to it this long-short market arbitrage fund. So that's neutral to what the market does. And the way that side, the 30% additional long and the 30% short, the way that makes money is as those come together. So the most expensive come down most of the time, and the cheapest tend to go up most of the time. And so that over the full cycle, what we hope happens is that when the market's going up, the long side does well. Hopefully that should do better than the market, and it should get some additional return from the arbitrage.
Then when spread,
from the spread squeezing together, right?
Okay.
And then as the market goes down, the short should go down faster than the rest of the portfolio. So it should provide additional protection when it goes down. The reason we leave it fixed at 100% and not try to guess where the market will go is that it's very hard to determine where the market's going to go. Nobody knows, is this a market that's going to go up? Is this a market that's going to go down? And over the very long run, the way to do the best is just to be completely exposed to the market. What that means is in the short term, you'll decline with the market, you'll go down. The fund will go down if the market goes down. We hope that the short provides some additional protection. Gotcha. We hope that being in undervalued stocks provides some additional protection. And those things together should help it outperform through that market. But it'll go down. And then when the market goes back up, because the market will go back up again, and in 10 years, 20 years, 50 years, you'll want to have had exposure to the market the whole way through, because that's the way to make a lot of money.
So some way or another is a way to control a little the volatility also in the short run, but having the same exposure and the same profits in the long run.
Exactly.
That makes sense.
And you are applying this strategy through an ETF,
right?
That is called Acquires Multiple ETF.
The Acquirers Fund.
The Acquirers Fund.
Yeah. And the ticker is ZIG.
CIG.
Yeah, Z for Zig.
Why you used this approach, ETF approach, and not a mutual fund to apply it, your strategy in this case? Because it's curious that you use an ETF and not a. It's curious for the European vision, okay, and not a mutual fund that is the normal situation here for managers. Why you choose this way to do it?
Well, the ETF has very significant tax advantages over a mutual fund. So a mutual fund or a limited partnership, which is often the structure used for a hedge fund or a managed account, all have the same properties, which is that when the manager sells a stock that has gone up, it creates a taxable gain for the person who is the ultimate investor in that account or mutual fund or limited partnership. And so they have to pay tax on that event. What the ETF is able to do, it has this special create redeem function built into it. That's what it's called. And we're able to move the capital gains out of the fund without them being paid by the ultimate investor in the fund. So the ultimate investor in the fund just sees where they buy it, where they sell it. They don't get any flows, so any dividends that are paid flow through to them, but they don't have to pay tax in the interim. It's unusual to have this type of strategy in an ETF. This is a strategy that's typically put into a hedge fund, into a limited partnership. But I looked at, and ETFs are still very new. I think that they haven't been fully exploited. We don't really know what they can do. And I looked at it and I thought there's no reason why you can't have this strategy inside an ETF. And I wanted to make it available to every investor rather than just people who could invest into limited partnerships, which are accredited investors who have high net worth and so on. So we put it into the ETF. It's been very well received. It's performed reasonably well since we started, so I'm very happy with it so far.
I can bet.
So I think professional investors or investors that are used to invest in United States from Europe, they can buy your ETF through the American brokers that they use. But when we are going to have your ETF for a normal investor here in Europe, because we want to invest in your ETF?
I would love to make it available. The difficulty is it's subject to the SEC regulatory regime, and to bring it to Europe, it would need to be subject to a second regulatory regime, and sometimes they're in conflict. One thing that is a requirement of the SEC might be not allowed in Europe. So I think what is more likely is we'll set up a second ETF in UCITS structure in Europe, and then that will be available to European investors. And I don't think we'll do a US strategy in that. I think we'll do a global or an international strategy in that.
Absolutely.
Or maybe a European-focused strategy.
The last thing that I wanna ask is what we can find in Deep Value book that we didn't talk today or in this interview.
Well, the reason that I wrote the book is that when I tell people that the type of companies that I like to buy, the businesses that I like to buy are businesses that are depressed at a cyclical low, that might be losing money. And people say, well, why would you want to buy that? We want to buy companies that are very glamorous. We want to buy companies that are making lots of money. And so I wanted to explain the mechanism, the mechanics of why you want to buy these companies, why these are better companies to buy than expensive companies or than glamorous, profitable companies, because it's not intuitive, it's counterintuitive. But the nature of investing is that it's a game of where it's relative expectation. So if the expectation for the company is very poor, it only has to do a little bit better for it to be re-rated up a lot. If the expectation for the company is very positive, it has to do something that's already built into the price of the market. You're already paying for those very high expectations. So it has to do something even better again for it to go up more than the market. And most of the time, they don't. Most of the time, what happens is the other way around. They disappoint. So the safest place to be, paradoxically, again, is in these companies that are undervalued, but are strong in the balance sheet. They might be losing money on the bottom line, but their operating income is very strong, and the management is doing something about buying back the stock. So that's the sort of company that I like to invest in. And that's why I wrote the book.
Okay. And I'm going to add one thing. Not only a good study, but a great stories about great investors. I love them when I wrote the book. I love them.
I appreciate that. Thank you.
¿Alguna last question? Do you have any
No, I
other last
just
question?
wanted to tell him that actually his book is a great book, and the stories that he says, you know, this I Can manifesto and all the other that is I don't remember now. It's an Australian company, very interesting also.
Yeah.
You know, there are many stories around that you know, make the book really interesting. Not only the technicals that are super interesting, but at a time the story, the flow of the info that is awesome.
Right.
You know,
Thank you very much. It's very
I
kind.
love it.
So thank you very much for being here with us in this interview, for being here with us in Spain, for coming here to visit us. We invite you again.
It's been a
I've loved it.
pleasure.
I've absolutely loved it. I'd
Invite
love
you
to come
again
back.
today.
Thank you, Tommy.
Madrid
in the
is
camera.
Madrid is beautiful. Madrid is beautiful.
For you not
come
to
back. I'll
forget
come
it.
back. We'll come back. We'll come
Thank
back.
you.
We love Madrid. We love Barcelona. Everybody's been so friendly. Love the food. Love everything
Yeah.
about it. It's been amazing.
So it's a pleasure for us.
Pues hasta aquí este casting study y esta larga entrevista con Toby que hemos disfrutado en 2 episodios. Nos vemos en próximos casting studies. No os olvidéis comprar el libro de Toby, es espectacular. Seguirlo en las redes sociales, seguir el canal, darle a like y en fin, ya os estoy pidiendo demasiadas cosas. Nos vemos en próximos casting studies.